Hey traders, Jason here from Leavitt Brothers. So in this video, I'm going to talk about how to use the tick to call intraday turns. The tick is just an indicator. It counts the shares that are traded at the bid versus shares that are traded at the ask. It gives an idea of whether sellers are hitting the bid and being more aggressive, or if buyers are hitting the ask and being more aggressive. And then the tick average is just a moving average of that. Before I get started, quick reminder: come check us out at Leavitt Brothers. We offer market analysis, trading ideas to the financial community. We've been in business since 2002. You don't last that long in this industry unless you're actually pretty good. Come check us out. You can see the Leavitt Brothers homepage here. There's a video right here on the homepage that you could get an overview of what we cover. You can see right here. Also, we offer a Masterclass. So if you're the kind of person who wants to actually learn, you're in the learning mode, you want to read books, you want to take a class, it's like an A to Z class, everything you need to know about how to trade the market. All right, let's get into the video here. So uses of the tick. So one, we can use it to confirm or deny strength. Okay, so if the market's moving up but the tick is staying flat or staying down, or maybe it can't get above zero, that would be a warning. That would be a denying strength. Or sometimes you have a market that is flat and the tick starts to creep up. That tells you that buyers are starting to get more aggressive. So you can use it to confirm or deny strength. Second, positive and negative divergences are formed. Okay, so the market pushes up, then it pushes up even higher, a higher high. But if the tick does not match that movement, if the tick puts in a lower high, that'd be a negative divergence. The market's probably going to reverse. The opposite happens. Sometimes you have a market that is stair-stepping down, lower low, lower lower, lower low. At some point in time, the tick will not confirm the lower low by it will itself put in a higher low. So that tells you that either the buyers or the sellers are starting to run out of energy in that direction. There's a reversal is probably going to take place. And then another use of it, as you'll see, is trendline breaks, where when the tick will steadily move in one direction and then suddenly break a trend line. And that tells you that there's going to be some sort of change. Oftentimes you get a positive or negative divergence forms, and then a trend line break forms right afterwards. You get like a nice 1-2 punch. So what I'm going to do here is I'm going to just go through a handful of days and just show some examples. All right, so what we have here is and this is the same for all the charts, so I'll just tell you what I have here. We have, this is a 5-minute chart of the S&P 500 up above and the tick down below. So 5-minute chart down below with the tick, you have this blue line is the 8 EMA, and the orange line is the 21 EMA. Okay, 5-minute chart. This covers one entire day. This was April 18th. So let's walk through what took place. All right, so first you have the market opens, and you could see here that it's kind of just rolling up and down, trying to figure out what it wants to do. The tick average here, you can see, is slowly trending up. So there's a little bit of confirmation, but we're not exactly printing a high number here. It just kind of says that like maybe a little bit of strength is brewing. But then what you have here is you have the trend line gets broken here. Okay, so we get a little bit of confirmation, but not a lot of confirmation. But then the trend line breaks, and then as the trend line breaks, you can see that that's when the market heads south also. Okay, moving forward in the day, you have the S&P puts in a lower low, but while that's taking place, you see the blue line here? That's the 8 EMA of the tick. It's putting in a higher low. So that tells you that although the sellers are still in control, they're losing control. Okay, so you can see, and then the market rallies after that. Fast forward another couple hours, you have the S&P matching its high here, but as it was matching its high, the tick had already started lower. Okay, so that's a negative divergent. It tells us that the uptrend is probably going to reverse down. That's exactly what happened. And then we fast forward towards the end of the day, we have lower lows here, but higher lows from the tick there. That tells you that we're probably going to reverse off the lows. Too late in the day to play it. But as you can see, the chart played out very, very smoothly. Like you either get, you have a little bit of confirmation over here, Okay, but then the trend line breaks and matches up with this. Then you get a positive divergence, negative divergence, positive divergence. Whether you day trade the ES or day trade index ETFs, or just use the movement of the indexes to help with signals from individual stocks, which I don't always recommend. But if you do that, there's a lot of information that can be gathered from the tick chart here. All right, let's move to the next day. So here is April 14th. So this is going to be last week. So this is what I see here. So during this period here, the market is trying to move up. Okay, it's very, 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 very slowly trying to move up, but yet the tick over here is like trapped under zero. Okay, so even though the market's trying to move up, the tick is trapped under zero, so there's not really a whole lot of buying pressure. I would consider this to be non-confirmation. And if you're long in here, you got to have a really tight stop, because noting that you're not getting confirmation, you just have to use a really tight stop. Then what happens is you get a trend line break, and when you get a trend line break over here, the market breaks down over there. Okay. Then moving forward in the day, we got a positive divergence. We have lower low there. We essentially have the same low here. That's a positive divergence. We also have a trend line break over here. So combination of positive divergence, trend line break there, matches up there, and you can see what happened. The market started to move up. And even if you look in here where the market was essentially flat, but the tick over here was starting to move up, it told you that even though the market was flat, but beneath the surface, buyers were starting to get more aggressive. So then the market reversed up. Over here at the top, we did not have a negative divergence, but what we did have a rapid decline in the tick. So no negative divergence, but a rapid decline in the tick told us what was going on beneath the surface. And then from there, the market moved down. We did get a positive divergence over here. Boom, boom. So if you're short going into that, you're probably going to be taking profits over here. It turned out that the market went lower. That's just the way it goes. We got a positive divergence. You got to respect it. And the market ended up going lower, but it doesn't matter. So again, we have, non-confirmation over here on the left side. We got a positive divergence, supposed to a trend line break towards the middle of the day. We got some brewing strength over here midday. And then, the trend of the tick told us that sellers were getting really aggressive here in the early afternoon, and then we got a positive divergence late in the day. All right, let's move to the next day. Okay, so here is April 13th. Okay, so we get this, the market opens up, spends the first hour trying to figure out what it wants to do, and you can see the tick moved off its high. First of all, I should say early tick average prints are not very useful because they use data from the next day. And when you're talking about short-term trading, I don't really want to carry yesterday's sentiment and such to the new day. So those aren't really useful. But I'm looking in here as the market is kind of consolidating here. The tick average is able to stay above zero, which is slightly encouraging. Okay, if I were to take it a step further, in here, this is the 5-minute chart. So this is like 1, 2, 3. It's like 8 5-minute candles. So there's 40 minutes there. The market is trading sideways in a small range. And you can see the tick had already started to move up. So that tells you that as the market is like very quietly trading in a range, beneath the surface, buyers are present. They're being slightly more aggressive than the seller. So it tells you that the next move is probably going to be to the upside. So if I fast forward here, you could see, you can consider this maybe a trend line break, although you got to give it a little bit of room. Okay, I prefer trend line breaks to have like distinct, humps to them. This one was just like a steady grind, and then a rotation down. So if I fast forward a little bit during the day, we have a negative divergence up here. So we have an attempt to push higher there, higher highs. At the time that was taking place, we have lower highs here. So that leads to a move down. So, if you're long here, if you're playing this long here and you're riding this 8 moving average up, which is the blue line, when you see this negative divergence forming, no problem. Just tighten up your stop and let the market go. Like, you don't want to, after such a good move in here, given that this was taking place, you don't want to take a huge risk. Move your stop up and take your profit when it happens. Then the market breaks down. You can delete some of these. Then the market breaks down, as you can see, but as you can see in here, the tick the tick average stayed above zero. So because it stays above zero over here, I would start thinking that, like, hey, this is a dip within an uptrend, not the beginning of a downtrend. Okay. So if the tick over here would have, done something like this, then I would have started thinking like this is going to be something like this, and maybe the tick was going to come up and like get rejected, and in which case you're going to be looking to short some sort of a pop there. Okay, but because the tick was able to stay above zero, you start thinking like, hey, this is a buyable dip. So, and that's what took place. We have, the market pulled back, and then it just simply rotated back up, and then, I could even, you can even draw a trend line in here where, like right in here. Okay, so little double bottom here, broke a trend line here. And then that coincides with about right there. And then as you can see, the market rallied up the rest of the day. All right, let's look at the next example. Here is April 12th. Okay, so first thing we have here is market opens. You can see that it opens with a gap up over here. First 5-minute candles presses higher. Tick average is not very helpful, as I've previously stated. Simply because it uses data from the day before. So what we have here is we have a steady prints above zero, which is pretty good. But I'm zeroing in here where we have 5 consecutive up candles, and we don't have the same type of, the tick didn't really improve that much over here. So I'm starting to think that, market moves up, moves down, starts to move up, but we're getting non-confirmation here because the tick average would not go down. Would not move up here. Then, and I'm going to delete some of these. Then what you have here is this, the tick average here breaks down. So when it breaks down, that's certainly, if you're long, you certainly need to be really careful. So it breaks down over here, and then we get a steady trend down. Looking out another hour or so, you have flat trading here, and then you have flat tick average here, which seems like it's just in sync, but these are negative prints. So as the market is, here's yesterday's close. So as the market is consolidating in positive territory, you have steady ticks below zero. So that's kind of, to me, that's a little bit of, there's no sign here within the tick. There's no sign that there's buyers are really stepping up. So you're not going to want to be really aggressive going long there, but then you can put in a trend line there. It breaks this trend line there, and not a surprise that this thing breaks down there and starts heading south. We do have a positive divergence here, in here. Okay, so you can look at that and say, hey, positive divergence. So if I'm short here, this positive divergence is reason to exit the trade over here. And if you're aggressive trading, you want to go long, you can go long. It didn't work. It ended up breaking down over here, so you end up getting stopped out, and maybe you make a little, maybe you lose a little. And then fast forwarding a little bit more in time, you get another positive divergence there where we made a lower low. Tick was higher low, and this one slowly trended up into the end of the day. Okay, so use the tick to confirm strength or weakness. Use positive divergences. Use negative divergences. Use trend line breaks. There's a certain dance that it does throughout the day. And when they're in sync, that's good. And when they're out of sync, then you tend to get a reversal. So let's look at one more here. Oops. So here is April 11th. Okay. So first thing we have is market opens up weak, S&P down, and then just is stuck in a tight range for a long time. And the tick average is also just basically stuck in a range. Okay. Slightly slanting down, stuck in a range, nothing to get excited about, no real signals there. You could say that we have a trend line break here. Okay, so possibly possibly something's going to happen. We get like a little bit of a washout low print there. Then we got a trend line break to the upside. That coincides with right here, so maybe there's a reversal coming. And you can see here that we have, the ticks trended up, for about an hour there, but prices went nowhere. Okay, so if you attempted to go long, you end up just getting stopped out. If you attempt to go long a second time, you get stopped out. You can see, tried to get above zero there, but failed. Tried to get above zero there, was successful for a couple bars, but then eventually failed. And then we just kind of went down from there. We can, you can see a negative divergence here where it tried to move up there, but the tick had already gone below zero. And then overall, you can just see here, tick average is below zero pretty much all day long, confirming a steady downtrend. Okay, so hope you got something out of this. Again, we use the tick to confirm or deny strength or weakness. We use negative divergences, positive divergences. We use trend line breaks. Oftentimes, there are little hints and clues that the tick puts off that you could use to tell short-term moves in the S&P 500. All right, hope you got something out of this. Again, come check us out at Leavitt Brothers, where we give market analysis and trading ideas to the financial community. Also, check out our Masterclass. All right, see you next time.